Hello and welcome back to this Thursday on Crypto. My God, the markets are, well, nobody really knows what the markets are doing over in crypto land. We're trying to figure it out, but it seems to go a little bit up, a little bit down, and that generally means that we're in some sort of consolidation phase. That's what we see when we're in a plateau. But there's still a lot of interesting things going on, and let's hop right into them. Now, of course, that October 10th event, that flash crash that was sourced inside of Binance, things like that always have residual effects. They tend to compound and ripple through the ecosystems, and as the saying goes, that we will all see who's swimming naked when the tide rolls out. And that's exactly what's happening here. Clueless 333 writes, another body revealed, 600 market cap stablecoin. They probably had a hole from before, but the Stream Finance blow up plus balancer hack triggered this. And this is Stables Lab USDX. I saw a previous comment about USDX, which proved that the asset itself was looped inside of so many assets. That USDX was staked inside of USDY, which was staked inside of USDZ, which was looped inside of USDA through whatever. And these kind of things are exactly what we saw occur in the previous cycle collapse after FTX. For those who weren't there or don't remember so clearly, Sam Bankman-Fried was a major participant in the SALT conference in the Bahamas around 2020. At that conference, he single-handedly introduced a ton of lenders like BlockFi, like Celsius, like Voyager Digital to the Three Arrows team, who ultimately defaulted on a lot of their loans. Now, my take here is that Sam Bankman-Fried thought he was playing 4D chess, knew that if he could get all of these lenders to open up under-collateralized or fully uncollateralized loans with Three Arrows, that he could cause a cascading event, attacking Three Arrows, essentially zeroing out all of these companies and taking the turf for himself. This is how I see it. What happened at the end of the day was that there was an exploit on Terra Luna. They were migrating from one version of their contract to the next, and in that migration, a massive exploit was engaged, which led to the unwinding of the Luna Ponzi. Subsequently, BlockFi, Celsius, Voyager, who was actually a real business but took out for some reason a fully uncollateralized loan, they all went down. What we saw was that these bad lenders who were overextended on trying to chase yield and compete with each other, they all collapsed. What we are seeing now in DeFi is the same exact story. And the saying goes, DeFi would save us from all of these central financial lenders and etc. But the reality is we need to be able to clearly differentiate which vaults are actually coming from tried and true tested DeFi and which are in these crazy looped patterns, and then just have a sort of wrapper slash interface on top of it that makes it look like good DeFi. Now, the problem is, any sort of safe DeFi promises are going to be lower on the yield. When we see yields go up, you must ask, where does that yield come from? And the higher it is, the more sus it should look. So while all of this remains true, like, I'm shrugging it off. These are significantly less impactful than the Celsius collapse and the BlockFi, etc. Those had a lot of normie user monies inside of it, and quite frankly, I don't even know Stable Labs and the Stream Finance blow up. I don't know them either. So let them die for running poor risk management. That's what I say. And of course, this is echoed in my friend Chain Yoda, the consummate nihilist on crypto Twitter. The unstable, yield-bearing stablecoins capitulating right, left, and center long before any of them had a chance to become systemic like Luna. Praise the Lord. So he's echoing my sentiments. It's good that you blew up when you were small versus getting to a point where you become too big to fail, if you will. Now, something to look back upon is that a lot of stable and trusted yields have been solved a long time ago. So it's very interesting that we see these new competitors pop up and try to outpace legacy giants like Aave or like Yearn Finance, for example. However, they're all using this opportunity to sort of pound their chest. So when we go to Yearn, we see curated by Yearn, don't settle for anything best in the less. And it says, all the juicy yield in the world means nothing if you happen to lose your entire principal. And hell yes to that. That is what is going on here. So Yearn Finance is advertising against this narrative. And of course, for those who don't know, when you do go into a Yearn vault, and these are programmatic vaults, basically they are an on-chain strategy of like buy ETH, stake ETH, take out ST ETH, do more, and loop that to infinity. All of these vaults are automated. So this is Vault Bridge USDC. We see it with ETH. We see it with Coin. And they all have their own strategy, and luckily there is a risk profile in Yearn. So this is actually newer since I've been here, but look, if you're going to try to chase chase these yields, go on to something that's been established, something that's lindy for many years, and of course, something that at least has some understanding of the risk that you're undertaking. Now, in a positive note with all this drawdown, we're starting to see revenue generating protocols, which are, fuck yes, legitimate businesses, and they're looking at this dip in a positive light, basically saying the Aerodrome PGF buyback 1.84 million Aero. The Aerodrome Public Goods Fund has acquired max locked 1.84 million Aero as part of its programmatic market aware buyback model. What this is saying is that Aerodrome believes that their revenues are good, that they're a good business, and that they're now underpriced. People often ask me, Graham, what tokens should I buy? And while I don't love to say that because there's so many different sectors and you should really be owning assets that you care about, that you believe in, I mean, this is a very easy tell, which is buy the tokens where the founders and the projects and the DAO treasuries are buying it back themselves. What could look more positive for a long tail hold than seeing something like Aerodrome going in and saying that the market has underpriced us, we are going to buy back, and as they say, max locked. So I don't remember off the top of my head how long a max lock is, but I believe Aerodrome goes for quite some time into like the 3-year period. Now, what is Aerodrome for people that are confused? It is the decentralized automated market maker, or a DEX, and it exists on the Base app. Now it's being built into Coinbase app itself. Base app is going to be the everything app of Coinbase, and we can just see it here. It is a way to exchange assets. Again, this is using the AMM model, which is that users and teams and anybody, really, it's an open system, can provide the liquidity for those swaps. They can generate fees on those fees paid per swap. And well, this is how it works in Aerodrome. If each market can incentivize users with inflationary tokens, so there is a bribery market involved, which is an economic term, not necessarily a negative. And anyway, it's proven to be extremely successful, and it is facilitating basically all of the swaps on Base. So again, if you like assets, if you want just like a basic DEX DeFi product, Aerodrome is not only crushing it and scaling through Base app, but they're going out and they're buying back their own assets. Sometimes bear markets can be great for revealing who is full of shit and who is not. Now, lastly, a lot of people are coming out with new price targets for Bitcoin because obviously it's been performing like shit. Here we see that JP Morgan sees a Bitcoin price reaching about 170K within the next 6 to 12 months. And their take here is that, look, on the positive side, the JPM analyst noted that the recent rise of gold volatility has made Bitcoin more attractive to investors on a risk-adjusted basis, basically saying that gold is overbought. The Bitcoin to gold volatility ratio has drifted further below 2, implying that Bitcoin currently consumes about 1.8 times more risk capital than gold. Based on this relationship, the analysts estimated that Bitcoin's current market cap of around 2.1 trillion would need to rise by nearly 67% to hit that market, implying a theoretical Bitcoin price of close to $170,000 to match approximately 6.2 trillion of total private sector investment in gold through ETFs and physical holdings. So you can take what you like from that. If you believe that the gold run is actually a momentum play versus this flight away from the dollar, theoretically, both of them should be in response to this horrible fiat regime that we're in that is taking on like 10% inflation year over year. And yet, I recently saw that the dollar is strengthening. So I don't know. We'll have to play this out. Now, on a similar note, Alex Thorne, resident BTC bull at Galaxy Digital, says, I'm lowering my BTC bullish end of year target to 120, previously 185K. Now, let's remember, it's November. He's talking about end of 2025. So he is seeing some bounce in the Bitcoin markets. Just sent this note to clients. Whale distribution, non-BTC investments, treasury company malaise, and other factors contributed to BTC headwinds in 25. And what he's talking about here is very much what I talked about in the Bitcoin IPO episode, which is that OGs are selling like a motherfucker. He quotes in here somewhere that it's around $52 billion of OG Bitcoin that have moved in October alone in 2025. So that's pretty insane. That's a lot of Bitcoin being sold, again, from the consolidated few into things like ETFs, which are owned by the many. So we're seeing a distribution year. That plus he's noting that people are investing in gold and AI and that the DAT, the digital asset treasury bubble, was really a total dud and is deflating as we look at it. So he just says, hey, this isn't really good for Bitcoin, but that does not impact his 2026 bullish predictions, where he does think, again, this evens out and then we get right back to a consolidation period where we see more upside momentum. Of course, the government reopening and passing things like the crypto infrastructure bill will be drastically positive for the industry. We really do want to see firm laws get in place that root how we build these technologies and companies in the United States moving forward. With that being said, don't overlever. These markets are up and they're down and they're crazy and they're totally spastic, and you are going to get liquidated. You thought you were catching a bottom, but no, the bottoms, they just keep coming back. We can see this bounce between 100,000 and 104,000. And if you think you know when it's finally going to reverse, I mean, your chances are very slim. So stay safe. Give me a like and a follow, and I'll see you tomorrow. Good luck out there.